afternoon, everybody. I'm Sarah Steele, Director of Better with Money, and we provide financial education in the workplace really to help you understand your finances and reduce money stress. And today we're going to switch on to our finances post-COVID-19. Now, I think when we originally booked this webinar last summer, we certainly hadn't foreseen that we would still be in lockdown with furlough continuing and home working. And sadly, job losses along the way and reduced incomes caused by the pandemic has had a devastating impact on many people's day-to-day finances. Now, fortunately, there are no money problems that are unsolvable. So today we're going to be looking at the financial action plan to get yourself back on track. We're going to be going through getting to grips with what you owe, working out your budget, then looking at ways that you can save money and maximise income. Then we're going to look at how you can prioritise and consolidate debt, and then where to go for further help if you need it. Now, the first thing I want to say actually is that not all debt is bad. You know, most of us have to use credit or debt in some way to manage finances. It might be that you've got student finance to get yourself through university, or you've got a mortgage on your house. You know, and in simple terms, this is good debt because it's sensible investment in our financial future and should leave us better off in that long term. So it doesn't necessarily have a negative impact on our overall financial position. When debt does become bad is when it starts to spiral out of control and it starts to impact on our happiness. You know, bad debts are those that drain our wealth, not really affordable, and don't really offer any prospect of paying for themselves in future. So examples of bad debt might be a luxury holiday that you can't afford, or you're buying things on store cards that really you could have done without. So if you feel as if your finances are getting out of control, maybe you're living in overdraft or you're getting cash out on credit cards to get by each month, then it is time to do something about it. And taking control can actually feel a lot better than leaving it to fester and not knowing where you are. So the first thing to do when taking control of your finances is to write down any money that you owe. Now, I've been in this situation. I know that it can seem really scary at first, but it is the first step in taking control and working out a plan of what to do. Now, you could use a list like this that I've shown on the screen. So you write down what you owe, the minimum payment that you have to pay each month, what the interest rate is, and when you need to pay it by. Now, that interest rate is often called the annual percentage rate, which is the interest that you have to pay if you've got balance on the credit card or the loan or the store card. And that includes any standard fees that are applied by that lender. Now, every card and loan in the UK has to declare what the APR is so that it makes it easier for you to work out which debt is costing you more. And you should be able to find a note of what the APR is on recent credit card statements or the credit agreement that you had when you signed up for the loan or card that you've got. And the simple rule is that the higher the APR, the more interest that you're paying and the longer it's likely to take to pay off. So the higher the APR, actually the worse the situation is. The next thing to do when writing it out, as I've shown in the last column, is to determine whether the money you owe is classed as a priority or a non-priority debt. And we're just going to talk through what the difference is now. Now, priority debts, contrary to popular belief, don't necessarily have to be the largest or the most expensive debts, but they're the ones that carry the most serious consequences if you don't pay them. So examples of priority debts might include your mortgage or your rent arrears, gas and electricity debts, and even council tax. And the reason that these are priority debts is that you could, for example, lose your home if you can't pay your rent or mortgage. Or, you know, in the case of utility bills, you might be moved to a prepayment meter, which might end up then costing you more. So that is why you should always deal with the priority debts before the non-priority debts. Now, the consequences of paying the non-priority debts are less serious, but the lender could eventually end up taking you to court or instruct bailiffs to collect money from you. So the sorts of non-priority debts, these include overdrafts, personal loans, bank or building society loans. It could even include money that you've borrowed from friends and family, as well as sort of those store card debts, credit cards, things like that. So write out a list of your debts, what you owe, then class them as priority and non-priority. And then rearrange the order you've got them in. So the first thing to do is to put those priority debts up to the top of the list, and then put the ones with the highest interest rates, or those APRs, so that you can start to see which are the debts that I should be tackling first and dealing with. Once you've got a full understanding of what you owe, then it's start to think about, right, what's my financial action plan? And the first part of the plan, just like anything, is, and this is going to sound easier said than done, but is to ensure that you're not borrowing any more money, because it's very difficult to sort out your financial plan if you keep adding to debts and keep changing the situation. So try and draw a line in the sand. And then what we'll do is we'll go through the points on this plan here, one by one, so you can work out, how can I get myself from here to a better situation? Okay, so the first one actually then is working out your budget, getting a handle on what you spend and where your cash is going, to see if there's a way that you can get your income to cover your outgoings each month, and hopefully having a little bit left over to maybe deal with some of the debts that you have. Now, to help you, you can use one of the budget planners that we've got available on the Better With Money website. You'll find it under the employee resources section. We've got it in two forms. We've either got a PDF version that you can print off and fill in, or there's an interactive version that you can do online as well. Or if you wanted to, you can Google budget planners. There's lots out there, so find one that suits you. But what you need to do is try and note down, whichever budget planner you're using, everything that you're spending in a month, because you really want to identify where that money is going. And I find the easiest way to do this actually is to print off my last couple of monthly bank statements, because often I will find extras in there that I've totally forgotten about. You know, things like I popped to the co-op for a pint of milk and ended up spending £20 on extra food. So if you go through your statement line by line and then add it onto your budget plan, so everything from your essential spending, like your mortgage, your bills, then your debt repayments in the separate section, and then your fun stuff. That's the going out, the takeaways, the presents. Once you've done that and you're happy that you've got everything down there, then think about your one-off costs. You know, it might be things like Christmas. And when you know how much you're spending on Christmas, let's say you spend £600 on presents and food, divide that amount by 12 to give you the monthly amount that it's costing you. So if you spend £600 on Christmas, break that down to £50 a month and put that into your budget so that you can start to save for it now. Because what you want to do is see actually what you've really got left at the end of each month, accounting for all these different things that are going to come up. And if you do live with a partner and you're dealing with finances together, I definitely recommend that you fill in this budget together. You know, see all of the income you've got coming in, everything that's going out, and include both of your debts together so that you can try and get that holistic plan. Once you've written out your budget, then it's time to look at whether there's any non-essential items that you might be able to cancel to save money. And I try and do this a couple of times a year. You know, I look through the direct debits and the standing orders that I've got coming out of my bank account. Now, maybe it's that you've got magazine subscriptions and you don't read that magazine anymore. It just comes through the door and sits on the side. It might be that you're paying for Sky Movies, but you're just watching Netflix. So just try and think about, is there anything here that I don't need anymore to save myself some money? The next stage is then to systematically work through your bills to see if you can get a better deal. Now, the way I find best to do this is, first of all, I go onto a comparison website, and there's a few on here: USwitch, Go Compare, Money Supermarket, and see what the best price is that you could get from another provider for your service. Then compare that with what you're paying at the moment. If you could get it cheaper somewhere else, phone up your existing provider. Say, look, I've compared the market, I can get a better price, please will you match it? And often they will do that. They don't do it automatically. And it's a lot simpler to stay with your provider than to switch if you can do that. The same goes for insurance, so home insurance, contents, car insurance. Again, contact your insurer directly, see if they'll give you a better price. or take a look to see whether you've got any extras on your policy that you might not be using at the moment. You know, for example, I know on car insurance, because people are driving fewer miles this year, if you phone up your insurer, say you're going to do less, you might well get a small refund. Or it might be that you don't need key cover anymore. You know, your keys are sitting on the side in the hall. So take a little look at what your policies are covering and whether you can get a reduction. Now, if you don't want to compare the market yourself or you don't have time, there are companies that will do it for you. An example of that is Look After My Bills. They provide a free service to review your bills, and they switch on your behalf. What they do is they do get commission from the company they switch you to, but the commission is exactly the same that they get from all of the providers. So they're not being swayed or coaxed one way or another. They're just looking for the best deal for you. Another little tip is to take a look at your food bill. Try and write a meal plan for the week. See if you can stick to it, because according to the Money Advice Service, about 60% of people who make a food plan spend less on their groceries. And we have got meal planners as well on the Better With Money website, which you can print off. And also, just to know, I'm sure many of you do this already, but take a look at the discount vouchers available out there. If you look at the Money Saving Expert website or My Voucher Codes, they have all of the up-to-date vouchers for all of the supermarkets, so you might be able to reduce your spend on food. Now, one thing near the bottom here that I really wanted to mention, which was introduced during the pandemic to help us, is mortgage payment holidays. Now, these were introduced last April to really help people who were struggling to pay bills at the moment. And according to BBC News, about 2.5 million people had taken advantage of these by Christmas. Now, we've now got until the end of this month, so the 31st of March, to apply for a mortgage payment holiday if we feel like we need it and we haven't applied before. Now, what happens if you apply for a mortgage payment holiday? It will be granted for 3 months. And that means that you don't need to make your mortgage payments for that time, but interest will still be added. If you do then take that holiday, it does mean that because you've got interest added, your future payments are going to increase slightly to cover the break. But for the average householder, that's going to be about £20 to £30 a month. And that might just be the reprieve you need to get your finances in order before you start paying your mortgage again. Now, the best way to apply for the mortgage holiday, if you need one, is to go onto your lender's website. You can either search for mortgage payment holiday, but most of them have got announcements on their front page as to how you go about doing that. And the important thing about that 31st of March date is that if you take a payment holiday before that, your payment holiday is not going to be shown on your credit file, and therefore it shouldn't affect your credit rating. If you decide to ask for that mortgage payment holiday after the 31st of March, it might still be granted, provided you've been up to date with payments in the past, but at that point it will be shown on your credit file. So instead, in any situation, it might be better to think about, could I just switch to paying interest only for a period of time to get me through? Or could I agree a reduced payment plan rather than stopping altogether with my mortgage provider just to help me out in the short term? However, one little note I wanted to say is just be aware that if you're going to remortgage soon, you are often asked for the previous 3 to 6 months worth of bank statements as financial evidence that you can afford that mortgage. If they see on there that you've had a mortgage payment holiday, it might affect their decision to lend to you, despite reassurances that your credit score is not affected. So do think about that. And as well as mortgages, you can ask again for payment holidays on things like loans, credit cards, store cards, car finance. And again, you should request this by the 31st of March if you really need it, so that that isn't shown on your credit file. Now, one last thing on this slide I wanted to mention in terms of sort of saving money was council tax, as this is often one of the largest bills we have to pay each month. And the first thing to do is actually check that you've been put in the right council tax band, because there are 400,000 homes in the UK paying too much for council tax. Now, you can do that by checking at the gov.uk website, just put in council tax band. It will take you through to a site where you put in your postcode and you'll see what band you're on and all your neighbours in the same postcode are on. It may well be that you think, well, I'm in the same house pretty much as the person next to me and they're on a lower band. If that's the case, you can appeal to your local council to get yours reduced. Also remember that if you live alone or you're on a low income and you receive universal credit, or you've got somebody in your house with an illness like dementia or Alzheimer's, you may also be able to get council tax reductions, so do check that out. And the last thing on council tax I want to mention is that normally we pay it over 10 months. And then we have February and March off. If you want to, you can ask your council to spread that over 12 months to make those payments more affordable. So just a few ideas there as to how you may be able to reduce your monthly outgoings to free up some money to start getting your finances in order. The next part of the financial action plan is to maximise income where possible. And there are a few things to look at here. First of all, check whether you're entitled to state benefits. Now, there are a few state benefits worth looking at that you and your family might be able to apply for, particularly if you're on a low income. But the main one is universal credit, and that is designed to help you with living costs if you've got a low income and you've got less than £16,000 in savings. Now, there are plenty others, but rather than me spend the whole webinar going through all of the state benefits available, the easiest and quickest way to see which state benefits you might be entitled to is to go onto that Entitled To website shown there. If you fill in their questionnaire about your personal circumstances, it will take about 10 minutes. That's how long it took me when I did it. It will tell you whether there's any state benefits you're entitled to before you go into the application process. And that could be really helpful because there's been an 81% increase in the number of people claiming benefits over the last year. So before you get into that cycle of applying, just double check your eligibility. The other thing is find out whether you're eligible for any grants. There are lots of organisations that have set up charitable funds that give grants if you're in financial difficulty. And both the ICE BEM Fund and Support Network may have grants, so it was worth checking with them as well. I'm going to put their details up later. But if you've checked with them and you're not eligible for grants with them, you can go onto the Turn to Us website. They've got over 1,700 charitable grants available throughout the UK, and their questionnaire takes less than 5 minutes to do. So check that one out. You should also make sure that your tax code is correct if you're earning money and that you're not paying too much tax. Now, you can do this by logging onto the HMRC website and setting up your own personal gateway. It's a bit like online banking, it's just online tax instead. And then you can check that HMRC have got your correct earnings that they're using in that income tax calculation. Now, the standard tax code in England is 1250L, and that means that most people can earn £12,500 each year before you start paying tax. Now, that code might be reduced slightly if you owe money to the taxman or if you receive benefits through work like private medical insurance, which means that you have to pay more tax on that. But the starting point for me is check your tax code. If it isn't 1250, then try and work out why and whether that's correct to make sure you're not paying too much tax. Another thing, and we've mentioned these in previous webinars, is the working from home tax credit. If you're, tax relief, not tax credit, working from home tax relief. If you're having to work from home due to the pandemic, you are able this year to claim tax relief on £6 of your earnings each week to cover additional costs like heating and lighting. And you only need to have worked from home for 1 day this tax year to claim for the entire year. Now, it's worth about £62 to the basic rate taxpayer, or double that, £125 for the higher rate taxpayer. And you can either claim for this through your end of year self-assessment return if you do one. If you don't, go onto the website that I've shown here, that tax relief for employees. You can fill out a form online straight away. And unfortunately, you won't see a check in the post, but your tax code will be adjusted to make sure that you pay less tax for the rest of the year. And then the last one here, which I love, you can also look at renting the Rent a Room scheme, which allows you to rent out furnished accommodation in your home, and you can earn up to £7,500 per year and not pay any tax on that. Now, you can let out as much of your home as you want, but remember, if at the moment you're getting a single person discount on your council tax, if you do rent out a room, then you won't be eligible for that single person discount. If you earn more than £7,500 through renting out a room, you can still do that. That extra portion will just be taxed. So just a few ideas there then as to how you might be able to maximise your income. Okay, so a little recap then. So you've listed what you owe to people. You've put together your budget to see if there's ways of reducing costs and maximising income. So now you should have a really good idea of what you've got left over, if anything, at the end of the month to start paying off towards some of those debts to get your financial action plan in place. Now go back to that list of debts and then start to pay off your priority debts first and then those with the highest interest rates. Because what far too many people do is just simply split the amount they can afford and repay the debts equally. But that is a bad tactic because you'll end up paying more in interest payments. So pay as much as you can on those priority and expensive debts, and then when they're repaid, shift focus to the next highest rate debt and so on. But do check along the way that you're not going to be charged any penalty for overpaying if you're paying above the minimum each month. Now, while you're paying off your priority debt, you must make sure that you're paying at least the minimum payment on all your other debts to avoid yourself falling behind. But I wanted to just show you the effect of paying a little bit more than the minimum if you can afford to do so. So looking at the example on the screen, I've used the debt calculator that's on the Better With Money website, and you've got access to this for free if you want to. Now this shows that I've got a credit card with a £2,000 balance, and it's got an interest rate of 20%. And each month I'm paying off £40 towards that. And if I do that, what it's telling me is that I'm going to be paying £1,818 in interest, and it's going to take me 8 years to pay off. However, if I go to the bottom of the line there, if I just pay £8 more each month, so I'm paying £48 instead, I pay it off 18 months quicker and I save myself over £600 in interest. So if you can pay above the minimum, it is a really good money saving strategy to do that. It's also a really great idea to set up direct debits just to make sure that you're not missing your minimum payments, because just missing payments can have a detrimental effect on your credit score and can impact your ability to get credit in future. Okay, so we've been through most of the high-level actions you should take to start getting your financial action plan in place. But one of the most important areas is to try to cut the cost of the debt that you have, and there's a few ways that you can do that. Now, before you start looking at your options for cutting the cost of your debt, just check your credit reference files that are held with Experian, Equifax and TransUnion, just to make sure that your records are correct and that you've got the right addresses against all your credit cards and things like that, because just having one incorrect address on your file could actually reduce your credit score and impact your ability to get credit. Also, just think about signing up to a free credit score app like Experian or Credit Karma so that you can monitor what your score is month on month. There's no charge for doing that. And also you'll find that these credit score apps often give you tips about what you can do to improve your score as well. So once you've checked that, the next point, which might seem counterintuitive, is to use any savings that you have got to pay off debt. And that is particularly key at the moment because the savings interest rates are so low. I mean, the best rate scenario on an easy access bank account at the moment, you're getting about 0.5% interest, whereas you might be paying 20% interest on a credit card. So take out any savings at the moment, pay it off on debt, because then you could use credit cards instead for emergency payments if you have to. I know we've been taught to have rainy day money, but if you're in this situation, that's definitely wise advice, number 2. Then for those people that have got a good to high credit score, see if you can move any of the high interest debts, so the overdrafts, the credit cards, the store cards, see if you can move it to cheaper deal using a balance transfer facility. So this is where you might get a new credit card or a loan to pay off the old cards or loans, but at a lower interest rate. And when used correctly, this is the cheapest borrowing possible. Now, there's 2 main routes to do this. The first one is to get a 0% deal, where you get a credit card that's interest-free for a set period of time. And the better your credit score, the longer that 0% deal is likely to be. And at the moment, you've got Virgin, Barclaycard and Sainsbury's Bank are all offering 0% for 20 months if you've got a good credit score. But the golden rules of using these balance transfers is to never miss a monthly payment and to try to pay off that balance before the 0% period is finished. So that becomes a cheap way of paying it off. And also don't withdraw cash on the card because you won't get that cash at the cheap rate. And so if you do this correctly, it can save you hundreds of pounds in interest payments and give you that time to pay off the debt. Alternatively, some people might be better off going for a cheap long-term loan deal. Now, the less interest you pay, the more your repayments are going to be going towards clearing the debt and not just servicing the interest. Now, so for example, at the moment, if you took a loan of about £5,000, the cheapest rate you'll be offered at the moment in the market is about 2.8%, and that's from RateSetter. And obviously that 2.8% is going to be a lot lower than credit card APRs and some of the higher loan APRs as well. So check that out. Now, if you're going to consolidate your debt in the way that I've just spoken about, I definitely recommend that you use an eligibility checker first, just to see which ones you're going to be accepted for based on your circumstances, and because that will guard against your credit score going down if you're not accepted. Now, if you've got a lower credit card score and you're rejected for new credit cards, if you have got an existing credit card, you could say to your existing provider, look, if I move some debt that I've got on another credit card to you, will you give me a lower interest rate? And some of them will do that. They've got hidden offers. Number 4 on the list is to remortgage if you have one, to consolidate that debt. So rather than moving the credit cards to loans, you could look at remortgage to release enough money to pay off the other debt that you have. But although this seems like an obvious idea, just remember that a mortgage is a loan secured on your house and it is a priority debt. And if you can't afford to pay that, then your house could be at risk. Last point here is just to help ask your utility providers for help if you've got debts with them. Water companies are not allowed to cut off your service, and gas and electricity can only do it as a last resort. And many of them have got help available if you ask. Okay, so that's a summary of how to get your finances back on track. But I do just want to spend just a moment talking about if you're in that situation, if you feel that it's got too bad that you can't deal with it by yourself, or you don't feel mentally strong enough to deal with your financial circumstances. So it could be that you've got spiraling debt, you can't make the minimum payments. It might be that you're getting threatening letters through the door because you've got debts. If you're in that situation, then it really is time to get some help. The first place you can turn to is either the ICE Ben Fund or Support Network. ICE Ben Fund, they've got a 24-hour support line in case you or a member of your family wants to talk, and they can give you free, practical and tailor-made advice on how you manage your debt and your finances. Support Network, they work really closely with a debt charity pay plan. And again, they will offer you and your family confidential debt and budgeting advice and solutions. They offer really fantastic support in situations like this to help with your well-being. So please get in touch with them, no matter how big or small you think that your problem is. Now, if for any reason you don't want to approach the funds directly, then you can contact one of the other debt charities out there. You've got Step Change, Citizens Advice, National Debtline. They've all got qualified debt advisors who can help you and to help you with those financial plans. Now, Step Change in particular, I just wanted to mention because they have created a COVID payment plan. It was launched in October 2020. And the COVID plan is specifically aimed at those people who are facing short-term financial difficulties due to the pandemic, who might just need help for 12 months to get back on track. For example, for somebody who's been furloughed due to lockdown, but is expecting to be returning to their normal job. So you can contact Step Change directly if you think that this plan might be able to help you. If you're a student out there, there are a few other places that you can go to get help with finance and debt. You can speak to student services at your college or university to see if they've got any grants or loans or bursaries. And it's also worth taking a look at the government website, which highlights the financial help available. But of course, remember again, please speak to the ICE Ben Fund and Support Network because they may have some grants that you're eligible for. So we've covered lots of information today. I just wanted to bring it all together on one slide about how you can tackle your finances as we start to come out of this pandemic. So, if you can go through each of these columns and look at those squares individually, if you can tick off that you've done those, then you're going to be well on track to getting your finances back on track. And importantly, 80% of people who seek some kind of help about their finances feel much happier after doing so.